Fed policymakers meet this week, but how far are they from a rate cut? Welcome to Market Insight. I'm Elena Casas. The FOMC meets tomorrow for a gathering at which nobody expects rates to move. The central bank is stuck in a holding pattern as stubbornly high inflation forces it to keep rates restrictive. On Friday, the core PCE price index came in at 2.8%, adding to market bets of perhaps just one cut this year and likely not until September. To talk about why, let's bring in Victoria Bills of Banrion Capital Management. Victoria, hi, thanks for joining us. How do you see the Fed's dilemma panning out then?
It is definitely a dilemma indeed. A lot of what Fed, I believe, wants to do is to cut rates, but just the market data that we're seeing doesn't allow for them to move as nimbly as they would like at this time. We've been seeing, as we talked about, PCE and PCI data has been coming in hot. And we're actually still hovering, at least from the PCE side, very close to what we were back in February. So it's not a good idea for the Fed to even to be considering cuts at this time. Another core key indicator that I think is kind of showing, however, that what the Fed is doing is working on the flip side of this is that we're seeing consumer savings coming down, as well as and also outpacing consumer income and consumer earnings. So this is indicative that people are starting to not only dig into their savings in order to make ends meet, but essentially we're going to probably see a little bit of a cool down perhaps in the near future. And hopefully that'll allow the Fed to get to make that move on a rate cut in the near future.
If restrictive rates are actually having an impact on the consumer, then how long might they have to stay this high?
It's a good question. It's really going to be contingent upon how much we can actually get that core like CPI down. Prior to, so I would say like early 2020, right before the pandemic, we saw core CPI hovering around 2.1%. Right now, it's around somewhere close, like you said, to 2.8. So we're coming to that point where essentially we're kind of getting back to that normalcy or that near normal rates that we had post-pandemic. And so there's opportunity potentially for a rate cut to come when it reaches that level or when it reaches that point. But I think some of the estimates right now that are going around saying rate cuts potentially in September, that's where I would put my money at this time.
What sort of guidance do you think we'll hear this week when Jerome Powell speaks on Wednesday? Will he stay very cautious?
I think he'll continue to stay very cautious. This Fed has a tendency to, like we said, they follow the data and follow the numbers. And so I don't believe that Jerome Powell, despite what the market wants and despite what investors want, is going to move the needle or even move interest rates, even if it's an election year. I think that this Fed is very cautious about giving any sort of indicator that rate cuts may be coming in sooner, but also trying to make certain to not scare investors into thinking that there might be a rate hike. Again, I think that some of the like personal spending numbers that we're seeing, as well as job numbers, indicate that there is more of a rate cut potential happening in the future rather than an increase in rates. But I think Jerome and the Fed is going to continue to kind of keep a very cool head and try to keep calm, carry on, and also remind investors to do that as well.
You mentioned the upcoming election. Isn't there a risk that the closer the first cut comes to November, the harder it will be for the Fed to stay calm and steer clear of politics?
It's definitely going to always ring, or it's going to always potentially kind of indicate if a rate cut happens in September, for example, prior to the election, that perhaps Jerome Powell is trying to do something for the Democrats or trying to do something for the economy to maybe sway investors or to sway voters in a different way. But a rate cut in September will not necessarily impact investors as quickly as we would suspect. So honestly, that would, in my personal opinion, it would probably be more of kind of a fear mongering or kind of playing into politics if people kind of believe that that's the move or that's what's going to happen. Again, this Fed is very much about following the data and following the numbers. And if the numbers indicate that it's time for a rate cut in September, then that's what's going to happen, regardless of what the political outcome is.
How do investors need to update their strategy if the rates are not coming down throughout the summer?
I think that we can continue to see strong holding in high yield bonds, as well as into anything that's related to debt for the time being. Again, these are opportunities that have benefited heavily from a high interest rate environment. So I think that that's going to continue to be the trend. I think that investors should also continue to kind of monitor their stock portfolios or any additional, perhaps liquid alternative opportunities that could be beneficial for them to capitalize on those high interest rates, but also potentially moving that needle back towards potentially more of a stock-based portfolio sometime September or even like third quarter, fourth quarter, end of year.
Victoria Bills of Banrion Capital Management, thank you so much for that analysis. Well, that's your market insight. You can watch more videos on Reuters.com.